Good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we turn our focus to the manufacturing sectors, in particular Angostura Holdings Limited and Trinidad Cement Limited, for the half-year period ended June 2019. So let's take a look. There were some mixed fortunes, and let's turn first to Angostura Holdings Limited. And again, for that 6-month period ended June 2019, the company or the group reported earnings per share of just around 26 cents, which was a very impressive 13% increase from the 23 cents recorded in the prior comparable period of 2018. Now, it makes for a fairly good reading. Revenues were up just around 3.8%, from just around 334 million to 346 million, and overall gross profits were up also at just around 3.3%, from 168 million to just around 174 million. Overall profits for the period did increase from 48 to just around $52.5 million. So fairly good performance, well, quite a good performance actually from Angostura Holdings Limited. Now let's take a closer look at the revenue story. And as we can see, there was a nice upward trend, but there were some changes in accounting recognition starting in 2018. So let's discount the 2015 to 2017 period. And we see nice stable upward growth in terms of revenues, with the branded trade segment in that bright green fairly flat for the comparable periods, whereas the commodity trade segment was up from about 11.6 to $23.8 million in revenues, almost doubling over the comparable period. Now, let's take a look at the earnings trajectory for Angostura Holdings Limited. And, well, there was quite a dip from the 2016 to 2017 period, with earnings per share falling from 77 cents in that bright green column to just around 54 cents per share for the half year 2017. However, since then, there has been a nice upward trend or recovery in terms of earnings per share. Dividends paid, as measured by the trailing payout ratio, however, have fallen in terms of the proportionate amount of earnings paid out proportionate amount of earnings paid out as dividends, and that has fallen from around 50% to just around its current level of around between 34 to 36%. Now, notwithstanding, we see that nice upward trajectory in terms of earnings. However, the change in dividends has not matched as yet. Let's see how that progresses over time. At its current price of just around $16.05, Angostura Holdings Limited trades at a PE multiple, or price to earnings multiple, of around 24.3 times, which is fairly in line with the sector average of around 24.9 times. But it offers a fairly unattractive dividend yield at the moment of 1.5% compared to the sector average of 4%. Now, take that with a pinch of salt, because Angostura Holdings, their trailing dividend payout ratio, as mentioned, is just around 36%, whereas their sector average is around, well, just over 100%. So, on average, most of the companies in this sector are paying a little bit more than what they're earning at the moment, possibly burning through cash reserves. So, on the basis of a nice upward trajectory and growth, but tempered by some fair valuations, Bourse maintains its neutral rating on Angostura. Now, turning quickly to Trinidad Cement Limited, and the CEMEX owned and controlled company for the 6-month period ended June 2019, recorded an earnings per share of just around 3.5 cents, which was a whopping 61% decline from the 9 cents recorded in the prior comparable period. In contrast to Angostura, not very good reading for a shareholder of TCL. Revenues were down just around 2%, operating profits down around 8%, and overall profits for the period were down just around 34%. Now, what has been causing some of this performance for TCL? Well, we can see in terms of revenue by segment fairly the opposite in terms of Angostura. There has been a quite pronounced downward trend in terms of revenues generated, and there have been declines across most of the segments, including cement, concrete, and packaging. So a fairly pronounced downward trend over the past 5 years or so. And when we look at domestic activity in terms of domestic production and sales and exports of cement, we see that on the domestic front, cement sales have been declining year on year. It has been fairly moderated, with just around a 1% decline in between the half year 2018 to 2019 in terms of cement sales, and exports have been increasing. Whether or not that will translate into improved earnings for TCL, well, only time will tell. Now, on the competitive front, TCL would have recently lost a matter in terms of an appeal with respect to the common external tariffs applied to its main competitor in recent times, Rock Hard Cement. Now, they were arguing for a 15% CET, or common external tariff, to be applied based on the similarities between the products of Rock Hard and TCL. However, the ruling was that only a 0 to 5% tariff should be applied. So again, competitive pressures will maintain for TCL going forward. So at a price of just around $2.45, the stock would have fallen around 10% year to date. It pays a fairly inconsistent dividend. We've seen revenue declines, margin compressions, and increased competitive pressures. And on that basis, Bourse maintains a sell rating on TCL. That's it for this week's edition. For more information, give us a call at 226-8773, email us at invest@boursefinancial.com, or check out our website at www.bourseinvestment.com. Have yourselves a wonderful investing week. This has been the Bourse Report.